All right, well, first I would like to welcome everyone to today's webinar. And I'll introduce myself and then Pat and Ryan. But my name is Andy Hawkins, and I've been with Bergen KDV just over 7 months. I had my own business for the last 10 years, and I helped business owners make decisions regarding growth, CEO, CFO services, leadership teams. And I merged my practice into Bergen 7 months ago. So I'm really excited about this program. I found it after I arrived, and I got to know Ryan and Pat and said, this is something we need to bring to a bigger audience. And so it's been my job to carry the torch and build this program and invite business owners in to participate. We ran our first session about 3 months ago. We had an unbelievable response from the owners that attended the session and the results that came out of that. And we'll share more about that as the sessions go on. But again, happy to have you here on behalf of Bergen KDV. Enjoy the next 4 weeks. I know business ownership sometimes can be a lonely place. You're gonna have a lot of friends in this room, people that have a lot of experience in different areas, and we're here to help any way we can. And with that, I'll turn it over to Ryan and Pat so they can introduce themselves. If you have any questions along the way, don't hesitate to ask. I'm here to track stuff down for you and make your experience enjoyable. So, Ryan?
Thank you, Andy, and good morning, everybody, depending on what time zone you're on, or happy lunch, or whatever it is. So like Andy said, throw questions into the chat. I mean, Andy will be looking at them. Pat and I, we talk a lot, and we do these presentations a lot. So the more people that ask questions, we'll pick them up at the right timing, or we can save them to the end, or we'll insert them in as we're covering the 5 principles. And so what we'll do is I'm going to kick it off. Sorry, I'm going to make sure I can see everybody. So we are going to be talking. Whoop, can you see my screen?
Yep.
Everybody good? Okay. So we're going to be talking today about how, if you focus on growing the value of your business with the end in mind, that you truly have the power to turn your vision into reality. We believe that if you got enough time, energy, and capital, you can focus on growing the value. You're going to be able to accomplish anything you want. And so what I'm going to do is Pat and I are going to give a little bit of our introductions about our backgrounds, like why does this matter? Why are we doing this? And then we're going to jump into the 5 principles that help people understand how to grow value with the end in mind. So I'm sorry, I keep losing the video. There we go. So a little bit of background on me. I'm going to tell you my story. So I grew up from the Twin Cities here. My dad, I got my start in entrepreneurship with my dad. He started our family business, mortgaged our house, and bought a couple $100,000 worth of used copiers back in the early 90s. And what happened was, over the next, call it 10 years, we screamed upwards with growth. We hit about 21 million in revenue and had 115 employees in 3 locations. I started around the financial crisis, and we'd been hit by the financial crisis very similar to a lot of other people. And over the next 5 to 6 years, I helped turn around the business, and swung it from in a distressed situation to a point where we had choices, but we didn't understand a lot of our choices, because my dad and I had this proverbial Groundhog's Day of, hey, I want to continue growing it and reinvest cash flow, and he wanted to continue taking money out, and we couldn't figure out how to get untrapped. So we ended up selling the business in 2014 to a local competitor, and have a lot of emotional and financial regrets from that, just not knowing what we know and teach now, which is why I ended up working for about 5 years, kind of freelancing. And then I started this podcast called Intentional Growth. It's got 300 interviews in there, and there's a lot of resources that Bergen has can help distribute. Really just trying to help figure out what the issue was, and it kept coming back to this issue of education, of understanding how to value a company and grow that value, and ways to monetize it with choices down the road. And that led me to a training where I was sitting in 2018, I think it was, Pat, and he was trapped. We were sitting there chatting. He was hearing my story, and I'll let Pat pick it up and tell his background. And then what we did is we co-founded Arkona after that, and combined our expertise to create the 5 principles that we're going to be talking about today, and form Arkona.
Hi, everybody. My name's Pat Hobby, and thanks for joining us today. I am an accountant by education and trade, and had a traditional route through public accounting and some private industry. And many years ago in the 90s, I started a fractional CFO services business, and did that for decades. worked with all kinds of different companies and various industries, and was involved in a lot of transactions. I had one client that just kept growing. We kind of hit a home run a couple times on acquisitions, and were able to integrate them really well. And it kept growing, and finally in 2014, the owner sold it to an ESOP. So we went through that transaction, and that was just a great experience for what was great for the owner and great for the employees. And we'll talk about that when we get to a principal later on if you join the cohort. That same company, 2.5 years later, was approached by a PE firm, and they wanted to buy us. They were rolling up a national organization. They needed us, and we said no many times, but finally they wrote a big enough check that our employees were happy, because they were the owners at that point, and it turned out to be a great transaction, benefited a lot of employees, and helped people move along in their careers. Went to work for a private equity firm for a while, which was just a great experience, understanding kind of the other side of those transactions. We were new in the private equity world, so we were in the process of buying companies. We literally hadn't sold an investment yet. We only had a few platform companies that we had bought. When we were looking at these, we were always faced with the same question of, where do we focus our time and energy and efforts on these companies once we buy them? I mean, you do all your due diligence, you learn everything you can, but then once you acquire them, you're faced with the real choice of, what is it we spend our time and energy on? What's the most important? Came across a gentleman in Boston who had a tool that he used and licensed out to people to help them analyze companies and figure out which areas to focus their time on in order to grow the value of the companies. He had training in December of 2018 it was, and I went to it because our PE firm was licensing this tool, and I was trapped. I was sitting beside Ryan for 5 days, 10 hours a day, and there were just enough seats in the room for the number of participants, so I couldn't move, and it was a good thing, because I joke with him all the time about that, but I really enjoyed it. I found out what Ryan was doing with business owners and his focus on education and learning his story about their company, and it just resonated with me. And he and I started talking, and over a few months decided to kind of branch out and form Arkona, put a 2.0 version of the material he had already developed, and that's how we launched Arkona. We've been having a blast ever since.
And when we talk about why this all matters and what is intentional growth, it is a combination of creating wealth, enjoying work, and making an impact. Like, why run a business? Is it all worth it? Like, all the sacrifice and risk we take every day. And we think that if you're creating wealth, enjoying work, and making impact, and you're living in the middle of that, then you're having fun and you're making progress towards your goals. If you're not, if you're enjoying work and making an impact, you're not making any money, you're going to wake up one day and go, what's this all for? Or you could be making a lot of money and having a lot of fun, but at some point you're going to wake up and say, I need to do something that's above and beyond me. So by living and focusing on the middle of this, then we can make sure that you're making progress towards your goals and you're on track.
So people should go back that way, if you would. People should take a mental picture of that. Ryan came up. Ryan's a graph guy. I'm a rows and columns Excel kind of guy. But that's a really great visual. Those are his kids. Those are his twin daughters behind there that we saw for a second. That's a really great visual, and that's worth taking a mental picture of.
And because I think the big thing is, like, when we think about our business, and this is where the 5 principles come into, what is the purpose, and this is what we're going to be covering over the next 50 minutes, is how to use these 3 as a lens to shift your mindset to be able to make sure that you're focused on the center of creating wealth, enjoying work, and having impact. And the purpose of these 5 principles is to get clear on what you want from your business and why, using these 5 principles as a framework for thinking. And then the second is how to focus on growing the enterprise value of your company so you have choices of freedom, really truly seeing your business as a financial asset. And then the third one is how to use the financials as a strategic roadmap to understand where you are today and how to get to where you want to go, so you can track and measure and monitor the progress. Because at the end of the day, everything falls into the financials, and there's a lot of truth to be said in the truth that's in the financials. And if we look at them the right way, we'll be able to measure the progress on our way there. So the first principle we're going to be jumping into is the first one is your driver. So these 5 principles, they go in order because they stack on top of each other concepts. So that way, by the end of understanding these 5 principles, you can get clear on what you want and why, and how to grow value towards the direction that you want. It's the first and foremost key part of this that's crucial is you need to understand what you want from your business and why. When you're unintentional about this, I don't know, Pat, which one you want to do?
This one. This is
okay.
I'll do the unintentional. I've been involved with a lot of transactions over the years, and the ones that fail, especially close to the close, even at the closing table, it's usually not about the money. It's usually about some other intangible that the seller just hadn't thought about, and when faced with the reality of closing a plant, changing the name, laying off half the employees, those kinds of things, that's what causes them problem. When you're unintentional about understanding what you want from your business and why, you're really making decisions in a vacuum, and you don't even understand what the long-term implications, both financial and non-financial, of those decisions are. We talk about people feeling stuck and not making progress. If you're going to bed at night or waking up at 2 in the morning, or when you wake up and you just have this sense of being stuck or aimless, or man, I've worked so hard over the last year and I'm in the same place I was a year ago. That kind of feeling is a result of not being being unintentional when it comes to understanding what you want from your business and why.
And as you can see, we're going to compare and contrast what being unintentional and intentional are. And when you're intentional, you understand the impact of your decision. So you're not wondering, am I making a decision that I'm going to regret later? You understand how the business fits into your life outside of just the money, the happiness that you get in the business, whether it's satisfaction for strategic leadership or if it's disrupting an industry, whatever it is. And you have a goal, and you use that goal as a framework for decision making to make sure that you're staying on track towards the goals that you ultimately have. And you know how to identify if you're heading in the wrong direction, how to course correct. And you know what success looks like, and you have a plan to achieve it. I don't want to underestimate anybody to underestimate this principle, because I do a lot of Vistage and EO workshops where I'm presenting in front of business owners. And this one woman, after 3 hours of the 5 principles in this financial presentation that we give, she looked at me and she goes, she has a very successful business, I think like 50 million in revenue or something like that. She goes, you're just saying I have to figure out what I want and why, and then I can build a plan to go get it. I'm like, exactly. Like, we can reverse engineer any kind of plan, but if you don't know what you want and why, it's gonna be very difficult to help you go get there. And that's why we like to use an analogy, as Pat said. I'm the image guy and the picture guy, and he's the rows and columns. But I think about Google Maps. It is one of the most powerful tools on the planet. But if you don't plug in point B, what happens? Nothing. You just sit here and it's just idle because you don't know where you're trying to go. You throw in point B, and now everything syncs up, and okay, like, are we flying? Are we walking? Are we biking? What is the budget to get there? How long do we want to take to get there? We're not going to go fill up in gas in Los Angeles on the way down to Florida. And so by identifying what our long-term goal is, that then we can have everything come into focus that is going to help us make progress, or things that we can ignore. And the challenge that I want to give everybody is, this is not just another revenue number. This is about, what is it that you want out of your family, out of the business, the impact that you want to make. It's so many times you say, what do you want from your business? People want to go from 5 million to 10 million, 25 million to 50 million. They want to double their revenue, but they haven't really thought 2 or 3 degrees, or 2 or 3 levels below that or above that, however you want to describe it, to realize that it's multidimensional and the business fits into our life in more ways than we can think of. Pat, you want to take this one?
Yeah, when we talk about how do you define success, it's to work in the business at some capacity until you want to have that choice of picking the role that you want to have while working in the business. You can separate, and we'll talk about ownership versus an employment role, being able to get rid of your day-to-day responsibilities, but yet keep your ownership role if you wanted to, if that's the choice you wanted to make. Being able to take some money off the table. People spend their whole lives building their business, and a lot of times a large part of their net worth is tied up in that. And sometimes you want to be able to take some of that off the table, but continue to run the company and have that choice. Family legacy, second generation, third generation, a family name, the employees that you recruited. Ryan didn't go into it, but the day they sold their company, he had to lay off 60% of his employees. All of those he had recruited into the business. That it may be okay. You may be in a situation one day where that happens, but if you aren't thinking about that, then you're going to have a problem, and that's not what success looks like. You may want to have an impact on your community or your industry and give back that way. And you may want to sell at the maximum price. You may say, I need to maximize the purchase price and what goes in my bank account. That is okay. It is not for people to judge. What we're trying to impress upon people, think about these things, define them, get them clear in your mind so that the choices you make about your business will lead you down a path so that when you get to the end, you'll have success when you get to that point. It could be 3 years, 5 years, 25 years from now. This is not about selling your business. This is about understanding what it means to you today and getting the most out of it while you're involved with it.
Well, and I think about, like, you know, Pat's been a CFO for 30 years of his career, and the amount of, like, if you don't know what you want, that most of the issues that my dad and I had, which we're still very, very close, we're really good friends, and, you know, very, very, very close. So it didn't damage the relationship, but I see it where it happens many times because you have one stream of cash flow, whether you're going to reinvest or take the money out, what you're going to do with the business, all of that ripples through every decision making based on what you want. Selling, not selling, selling, not selling. Are we going to go this direction or not that direction? There's a constraint of time and capital, and by understanding what you want, then you can funnel it in the right ways and the places that you think are going to make the largest impact, and have the choices that you want to keep living in the intersection of that intentional growth like we talked about. And being clear helps everybody, not only your partnerships, but also the management team. So that way everybody knows that you're on track to the certain place that you want to go. So as we then go into, sorry, I keep losing the video. I'm gonna have to have you over here, Pat. So as we then go from, as you can tell these stack on top of each other, once you identify what you want and why, then the next logical question everybody says is, well, can I afford it? And what does this mean to me financially? And we're going to get into the rows and columns that I know Pat actually
finally, 18 minutes into the presentation, we finally
where everything comes into play. So
talk about numbers. Go ahead. Sorry.
You need to view your company as a financial asset, not just a job.
Say that again.
I want everybody to take, you know, there's a couple of things, this is going to be one of them, that you need to view your company as an asset, not just a job. And by a job, we're talking about lifestyle businesses. My dad and I had a $20 million business, but what we now realize is it was a lifestyle business, because what we were talking about is how do we suck all of the cash out of the company that makes sense through salary, perks, and distributions. We were not focused on what is this thing going to be worth and how much do we need to reinvest to create a valuable asset somewhere down the road that's going to create a lot of choices.
When you think about the financial targets, both yourself and your company, and you're unintentional, one of the things is you don't know what your business is worth today. And when we talk about worth, a lot of people think, well, I'll never know what my business is worth until somebody buys it. That's not true. There are ways to get to that. And then what would go into your bank account? When we talk about worth, we're literally talking about net proceeds. What would go into your bank account if you were to sell it? And again, this is not about selling your business. This is about understanding the value of your ownership in your business today, because it puts that stake in the ground and establishes the foundation that you're going to use to make decisions to move forward in the future. You don't know what your company needs to be worth in the future along the way in order for you to feel financially free. You're pulling money out of the business and not understanding the impact of those decisions. You know, is it hampering growth? Is it not hampering growth? Is there a better use of that money from a return point of view? A lot of people we've worked with, you know, it comes to be tax time and they get surprised. You know, they've taken the money out and they bought a cabin, a boat, whatever it might be, paid for college tuition, and then all of a sudden taxes are due and there's a surprise. That's being unintentional about it. And if you were in a situation where your personal finances and your business finances and accounting is all mixed together, it just clouds things. That's being unintentional. It's hard to be clear about what you want from a financial point of view if you have that kind of mixing of information going on. So those are some examples of what can happen if you're unintentional about your financial targets.
And it's probably not going to shock you that the opposite is when you understand and view and run your company as a financial asset, you can be very intentional about what you are doing to track and measure and monitor the value of your business on an ongoing basis. Just as a note too for everybody, Pat and I have been doing these podcast series. One was how to view your company as a financial asset. We just got done with a multiple episode series about how to demystifying business valuations, and it's truly helping people understand how to view their company as a financial asset and how to be and where and how they can identify when they could be financially free while owning the business and not just hoping for some later date and time. And when you're intentional, you have your taxes and distributions clearly planned out for years in advance. You can say, here's where I want to go with the company. Here's the vision, here's the strategic plan. You have an idea of how it's going to fund that strategic plan and how that impacts your distributions and your taxes. That's really what we all want to know as entrepreneurs, saying, here's the goal, here's what we're trying to do, here's how we're going to get there. And you're not, like Pat said, making a decision. We actually were on a training call with one of the cohorts that Andy was talking about, and this business owner said, yeah, I got the tax time and I had to take out I had to take out $200,000 in a line of credit because I didn't have enough cash flow because I did something else in the business and I bought a machine. So it's about understanding those trade-offs, and you can clearly see them, which reduces your anxiety. And then you have an idea of what your personal, financial situation is apart from the business, but you have an idea how the business impacts your personal financial cash flow statement as well as your net worth. And that kind of leads into the next topic here of the 3 financial targets.
So the 3 financial targets are, you need to understand what your ideal annual income is. This is while you're running your business. Business owners, they've worked hard, they're entitled to enjoy the benefits of owning a business and running it. But you need to think about, what is it I need personally from an income point of view to have the lifestyle and the kind of life that I want. Secondly, you need to understand what your net worth is outside your business. If you have financial advisors, financial planners, they can help you with that. But truly understanding what that net worth is critical to it. In my opinion, one of the most critical things is understanding the value of your business. For most business owners, their ownership and their company is their largest financial asset. If you don't have a handle on what that's worth, then you're missing a huge part of the puzzle, and it's hard to feel comfortable about the financial targets when that piece is missing. So having all 3 of these in having some clarity about all those is essential to moving forward.
And these 3 financial targets, think about it like the puzzle picture and then the framework of the puzzles. This helps you understand the reliance of your personal financial situation on the value of your company, because truly you're an investor of your business, and understanding what that could be worth at any given point is important for your financial advisor. And I'm going to show you a picture here. Again, I'm the picture guy. And then Pat will be diving into some terminology of how to better understand what this question mark is in of the value of the company. But I had this really interesting conversation. This business owner called me up after the podcast that Pat and I was doing, and literally he was apologizing to me. He's like, this guy had built like a $15 million home services business, and he's like, oh, I feel bad because I realized after listening to the podcast or this concept that the value of my business is probably overstated on my personal financial statement. So I had to go back to my financial advisor, tell them now that I understand valuations better that we have to reduce that, and I've got more work to do, but thank God I know now, and I didn't try and sell my company. So what this is showing you here is that if you wanted to maintain, so the first financial target, 200 grand in annual income, okay, great. And then again, there's some assumptions of not touching your principal, which if you didn't need to keep your principal, there's a lot of different math equations, but that's for your wealth manager. If you didn't want to touch your principal, you can pull 4% off without having to touch it. So then let's say like this pie chart for my dad and I, it was like mainly green. We owned our building that we had over in Minneapolis, but like we kept rolling the dice for, decades. And so by understanding what this company needs to be worth, we have to understand that in order to do some planning to say, are we free or not while we own this business? And, as Pat, as we get into the next slide about enterprise equity net proceeds, and you kind of get into this, maybe you can speak to like the debunking of people thinking about like, oh, I'll never know what it's worth until someone's willing to pay for that. And that kind of gets into planning this while people own the business.
Sure. And just kind of pretty quickly, we want to talk about the value of the business. The first value that we talk about is enterprise value. If you think about that top line market value, if you think about a home, it's really good to analogize this to a home. And you go on Zillow, you look up what your house is worth, that's kind of the enterprise value. When somebody, most times when you hear people say, I sold my business for $10 million, that's what they're talking about, is enterprise value. In a deal of any size, unless it's really small, if you sell your business, you get to keep your cash, but you have to pay off any funded debt. So if you have a loan for equipment or whatever it might be, you have to pay that off from the enterprise value. So when you add the cash and subtract the debt, that's called net debt, you get to equity value that you see there in the middle. And think about the home again. You have a home that's worth $400,000 and you have a $250,000 loan on it. Your equity value is $150,000. So now in our example, the person who's got a $10 million company, but all of a sudden their net debt is $4 million, their equity value is 6. So now all of a sudden we've gone from 10 to 6. Then if you were to sell your company today, you're going to pay taxes and maybe have some transaction costs that aren't included in that. A lot of you, if a lot of you are in Minnesota, maybe, or and tax rates are pretty high there, a little bit higher than in Ohio where I am. But you have taxes you have to pay on the gain. And people like Bergen's tax department helps you figure out what your basis is and your ownership, and they help you say, okay, they can run the calculation. If I sold it for 10, I have to pay off my debt and I keep the cash, I'm down to 6, and I've got to, if I've got $2 million, I'm making up a number, or of that in taxes and costs, then all of a sudden I'm down to what's the number? 4.
And how many partners do you have?
And I have 3 partners, and so I have to divvy that up, or 4 partners to make it easy. So it could be $1 million. I mean, again, we're making up examples, but we're trying to show the point here. One, you can learn what your business is worth based on the cash flow it is today. If somebody comes along and pays you a lot more for it down the road, that's great, but you don't want to bank on that. You want to understand what the enterprise value is, and it's called the intrinsic value. That's what we call it, based on the cash flows that exist today. You want to take that through this waterfall so that you could say, if I sold it for X today, I would put in my bank account Y, and then plug that into your net worth outside the business, what your ideal annual income is, all those other factors that were on the previous slide, and you'll get a pretty clear picture of where you are today. That is the stake in the ground. That is the foundation from which you say, okay, that's not enough. And I know Ryan's going to tell the story here in a second about a client we had that he thought he had enough and he didn't. But then that spurred him to develop a plan to get to where he wanted to go. If you don't know those things, if you're just going by your gut, you're just flying blind, and it's not a good way to be.
And the story that Pat's telling, that was referring to, I'll show this one, because this is where, if we were to go back and fill in that question mark, the net proceeds needs to be $3.5 million for this person to be financially free, and they can know this while they own the business. This whole, like Pat was saying, like, we just want to debunk people saying that, because it's just not true. You can measure and monitor the value of the business using the financials the right way every single day and month if you wanted to. Private equity, the entire industry is based on doing that. ESOPs do that all day long, where they don't have a transaction, but they track and measure the value of the company. And what that allows you to do, like Pat was saying, is once you understand using the 3 financial targets, if you're free or not while you own your company. So if you get an out of the blue offer, if you all of a sudden you want to pivot and get rid of your job and you want to just keep it as an asset, wouldn't it be nice to know what that asset is worth if you were to sell it for your financial planning purposes? This is what gives you, like Pat said, like, this is the point A, and then this is what allows you to then run scenarios on it, which is truly what we want for everybody, is options. We want people to have options to grow value and have choices based on the things that they want to do, but not have to sacrifice everything that they built. So this is, again, just filling in the void of the 3 financial targets. This person needs the net $3.5 million, so they would reverse engineer that, like Pat was saying, okay, well, what does the enterprise value and the equity value need to be for me to be financially free? Then I'm going to have the choices, and how that manifests is family members gifting the company to their kids because they don't need the liquidation, or just having choices to do what you want with the company long term. So there are three major levers that every single person on this call and every business owner has to make a lot of money and a lot of wealth in their time while they own the company. It's increase your EBITDA, increase your multiple, and pay down debt. I did a panel with a private equity firm where he said, Ryan, it's really simple. We buy companies, we increase the EBITDA or the cash flow, we increase the multiple by making it more transferable, and we pay down the debt, and we make a lot of money doing it. And just that simple. And everybody that owns a company has all of those resources and tools available to them if they shift their mindset and view their company as a financial asset. So as we get into principle 3, as Pat said, we talk about exit options, and I'm going to use Jim Stelton, the Bergen KDV team member who was in Pat and I's boot camp. I think Pat was like 2019 or something like that. And he said, this is not about, it's not about exiting, and this is not exit planning, but the reality is so many people put their head in their sand because they know they need to know this stuff and how they could exit, but they don't think about it because they don't want to put the webinar or the book or whatever it is that might be educating them on all the different exits anywhere in visible sight of their employees. But the reality is understanding these will help you march towards an outcome that is exciting for you, or at least gives you the focus to research and learn about the things that are going to be important to you. And the goal of principle 1 and 2 is to use them as a lens to look at the different exit options. And what Jim Stelton said was, if you don't know these exit options, even if it's 20 years out, you're letting, everybody that runs a business, myself included, is I want to draw my own and paint my own destiny in my entire life journey. If I do not know how it could end, then someone else actually has the pen and paper and is writing my outcome for me, and I'm just hoping and wishing that I get what I want, versus intentionally growing value to the outcomes that you want and the choices that you want.
So if you're unintentional, and by that we mean you don't understand what the various exit options are and therefore the implications of making decisions, you're petrified by the word exit, or you get an email or a phone call from a private equity and you're scared to even take the call or answer it because you don't even know how to have a conversation with them. You're confused. Ryan and I spend a lot of time, and I think there's a slide a little bit on ownership versus management role. This is a huge concept, and people who conflate those and put them together are being unintentional because they are very, very different. And they don't understand how exiting their ownership role or their management role might affect the other one. The exit options, the ones you pick, will have an impact on your ownership role and your management role, and those can be independent from each other. And this out of the blue offer, sometimes somebody will, we just had the big lottery that somebody in Illinois won, but it wouldn't be like that. But somebody shows up and has an out of the blue offer. You don't need to be scared of it. If you're interested in talking to them, you can say, hey, I understand what I want, what I need. Here's my business. Let me tell you what would it take for us to have conversations. And you're instantly going to gain credibility with the potential buyer. You're not afraid of taking that phone call or having that conversation. And I tell you, you're in the driver's seat when it comes to negotiating a deal, because if you know your stuff and you know what you're talking about, you're gonna just do nothing but drive your price up. If that's what you're after, or if you know you're on a path to grow the value of the business and it's going to take you 10 years, you can just ignore those people and say, I'm not interested. I guess you could say, unless you pay X, and X is 3 times what, or would finally get you there, and you would know that number if you go through this and do it right. You can just shortcut all that and have real confidence in what you're doing.
And I think what Pat was just referring to is where so much anxiety comes from. I mean, as we move into what does it mean to do this the right way and have a plan and understand this in an intentional manner. There was on a training call, one of the guys that was on our group trainings got an out of the blue offer for $25 million. And he's like, should I? And I'm like, I don't know. Should you? What do you want? What's it worth? He didn't know the intrinsic value of what it meant to him today. He didn't know his 3 financial targets. And again, he was going through the training, but there was no way and no decision framework in order to make the decision. It was like, well, I just don't know. Is the intrinsic value worth 15 million or 30. You know, he had no foundation to run his ideas or his scenarios on. And so when you're intentional and you understand the exit options, you can quickly understand the difference between your management role and your ownership role, which Pat, like said, we have a slide right after this. And when someone says, I want out, they know whether they're referring to their job or their financial asset and what that means to them personally and then also financially. And when you're intentional about this, you understand how all the different exit options will impact your role, the deal structure, when and how you get your money and your role post-closing. You also are clear that you're making progress towards the goals that you want long-term, and you know exactly how you would handle the out-of-the-blue offer. And that story that I just realized I forgot to tell in the last slides that is related to this one as well is this owner went through our group trainings and he said, you know what? He had about $15 million in revenue. He had 1.1 million or something like that in EBITDA, 70 employees, owned the company for 30 years. He'd sent I think it's 50 some of his employees to Tony Robbins Unleash the Power Within, which them and their couples, I mean, it had to have been 500 to 700 grand that he'd spent just helping his employees over the years. And he realized that on a 1.1 million in EBITDA, his company was worth maybe $5 million. You know, the net proceeds, like we talked about, after debt, taxes and debt, he'd walk away with $2.5 million. The financial advisor had $7 million on his financial statement. So he's like, huh, I'm $5 million short. That's a big deal. In order for him to hit his retirement number, his financial freedom number, he would have had to gut the company, fire his employees, and then sacrifice all of his personal drivers that were so near and dear to his heart. So he said, no, thank you. What I would like to do is take my EBITDA from 1.1 million to 2 million. So then I can then grow my value from 5.5 million to 12. And then I'll go from netting 2.5 to netting $8 million. And then I would like to sell to my employees in 36 to 48 months. He just shifted his entire mindset to grow EBITDA, to grow the multiple, and then to pay down debt so we can have the choices that he wanted to in a relatively short timeline. And he's definitely on track. And that's when you're intentional, you have that kind of clarity in what you're thinking about in order to drive towards your goals.
Go ahead. You love this one.
I'll tee it up, and then you can unpack it from the financial side too. This is where when people call me up, this topic of ownership versus management roles, I get calls every week, and people call me like, Ryan, I want out. Out of what? Your job or your asset? I'm like, what do you mean? They've never really heard that question like that, and I'm like, well, I don't have people call me up and be like, I really want out of my mailbox money. I get $1 million in distributions, and I live in Hawaii. Well, that's because your asset's working and it's kicking a lot of cash flow. Usually it's people that are burnt out because they're holding the whole machine of their company together. All the decisions go through them. They're the CEO or whatever their role is, and they're really, really burnt out of their job. They're not burnt out of their cash flow. And so by separating these two and understanding that you do not have to work at a company you own. I have Apple stock. I don't work at the Genius Bar. And I think a lot of people probably on this call can say the same. And so you can own an asset and not have a job there. So Pat, why don't you want to take that a little bit further?
Sure. It's just important to separate your roles from ownership and management. You have certain rights and responsibilities as an owner. You have the right to receive distributions, and you get the joy, if you're a pass-through entity, of paying taxes. As a management role, you're the CEO, you're the CFO, you're the VP of operations, whatever it is, you're the receptionist. I mean, you can be an owner and have any of those jobs, and it's important to separate those. We have so many clients where they're brothers, longtime friends, family members. They pay each other equally because that's just to keep the family harmony. It's not reflective of what people do. That's conflating ownership and management, and it causes numerous problems when you do that. If you can separate those concepts in your head and all the owners' heads, then you can really make progress towards saying, we're going to pay you as an employee what your job function is. You're going to get a distribution as an owner based on your percent ownership. That is the way it should work. And of course, there are family dynamics that come into play, but there are ways to deal with that. But people who walk in as an owner and want to tell every employee in the company what to do, regardless of their role, that doesn't work. That creates chaos and confusion and anxiety on the employee's part of you. And like Ryan said, you can be an owner and an employee, You could be an owner and not be an employee, you know, and obviously you can be an employee and not be an owner. And just having that clarity really helps separate those things. When you walk in every day, you're running the company, you know, or whether you're the CEO, the CFO, the VP of Ops, the sales manager, whatever it is, that's your job. And if you're not, you don't want to walk in with your owner hat on every day, because that's just going to cause confusion, anxiety, and to be honest with you, a lot of tension.
And a lot of stuff stems from that, like Pat said. And so when you have clarity, then you can, on principles 1 and 2 in your ownership versus management roles, you can say, then how do all these exit options impact my asset value and my options and my job? And what do I want out of each of those? Then you can actually look at these with the lens of clarity. And so, Pat, I'm just looking at time too, so we'll kind of keep the pace going on this one.
Okay.
And then because we got the principle 4 that I think a lot of people are going to like the meat on that bone. So that for the 5 principle or the 5 exit options, what we did is we took, Pat and I, when we created these, a bunch of list of attributes of probability of getting your money up front versus over time, control over the process, you know, getting max value versus not. And we just, you know, essentially created 5 categories, and we didn't talk about public markets to say, hey, here are the general ways that you can exit. The first one being internal, and it's a financial sale based on the risk of the cash flow, which we touch on a lot in the training. But the internal ones are family members, partners, and managers, and a lot of control. You got a lot of decent legacy control over, like, hey, like here's who I'm going to be selling to, and you have a pretty good idea of what's going to happen. You're not going to maximize purchase price, and you're probably not going to get all your money up front, but there's certain things that people would gravitate towards that they like. The second one is what we call acquisition entrepreneur. There's a bunch of other terms now that are floating around called search funds and acquisition or entrepreneurship through acquisition. It's essentially some younger person that, you know, could have came out of corporate America, like a corporate refugee, like, you know, a 3M or a Best Buy, someone that ran a division, and they've got some money behind them from a wealthy family or an investor and or an SBA loan, and they want to go buy a company and a job at once. So they want the equity and the job, so that way they can go grow their own company to create the financial freedom that comes with entrepreneurship.
The third bucket of exit options is ESOPs, employee stock ownership plans. It's a financial transaction. It's based on the cash flow of the company as it exists today. The difference is it is a tax advantaged sale. To the extent the ESOP owns the stock, say 100%, then that percent of income, there is no income tax on that at the federal or state level.
There again.
The company literally stops paying income tax. When the employees receive their benefit way down the road, years and years, they'll pay tax on that, like, you know, like a 401k plan. But it's an option that's least understood. It enables owners to satisfy a lot of those principle 1 characteristics about legacy, family, you know, but I need some money, that kind of thing, that seem in conflict with each other, can be satisfied through an ESOP. In the training, we go through that quite a bit. Private equity is the fourth. A lot of people understand private equity. There are companies out there. Ryan has a saying, if you've seen one, you've seen one. You know, they're all different. You have a right to ask a lot of questions, can be really good in certain situations to help an owner achieve what they want. But it's a company that either buys a platform company or a bolt-on to build an equity. Their goal is to make money for their investors, period.
That's it. Yep. And they have it both, and what we mentioned before, both ESOPs and private equity, they buy companies and then they grow value by monitoring the cash flow. So again, everybody on this call that owns a company is capable of measuring and monitoring the value of the company while they own it, just like everybody, like these 2 firms do. The fifth one is strategic buyers, and that's what a lot of people think about. That's, you know, different competitors, geographic location, you know, synergies from products to services. The point of this slide is there's a lot of different ways and combinations, but knowing what you want and your financial targets is important, because then you can eliminate 80% of the stuff you don't want and focus on the options that you want to create long-term. Most important things to consider are, again, principle 1 and 2. What do you want from the business and why? How do each of these impact your ownership versus your management role, your timing, and your desire for culture, legacy, and employees? And then what does it mean to you financially? I mean, how does it impact your cash flow over time, your net worth, how does your net worth that has grown or not outside the business impact your need or lack of choices or choices of the business, and then how do you grow value to accomplish the options that you want. So as we round principle 3 and get to principle 4, people go, okay, got it. Now I know what I want. Here are my exit options. Here's how valuations work. Now what do we do about it? Now it's time to increase the value of your company, and you need to grow the value and the equity value of your business to create the choices that you want long-term.
So if you're unintentional in this area, you really don't know in a substantial way if the decisions you're making and the choices you're making are growing the value of the company. You're just doing things. You're coming in grinding, doing more of the same every day. A lot of people in this situation that are unintentional focus on vanity metrics. Like Ryan was saying, I'm going to take my company from 5 million to 10 million or 10 to 20, whatever it is. That may or may not be a great thing. You focus on annual income as opposed to growing the value of the business. Of course, if you don't know what the value of your business is, it's hard to focus on that. You make choices about strategies or things you want to do, buy equipment, open an office, expand, whatever it is, just based on your gut. You don't want to discount experience and those kind of things, but boy, when you're unintentional and that's all you've got, you might be headed for a problem. It's human nature. When you're unintentional about understanding how to grow the value of your company, you focus on the things that you like and you're good at. It can leave, if in Ryan's world, he focused on sales. He's good at it. He likes it. His financials and his org chart probably weren't up to speed. I focus on the financials and the numbers. If I were running a company alone, our sales effort would stink. So you tend to focus on the things you like or you're good at.
And when you have an idea what your company is worth and you know what choices you want to create, what your timeline is, you can clearly see, okay, here's what I want to do with the company. Here's the strategies I want to accomplish. How are we going to fund that? And how does that impact my ability to take distributions, pay taxes? And then if what I'm funding the strategies are, how are they growing the value of that company? Because I'm going to be sacrificing distributions in the form of investment back into the company. So hopefully it's growing the value, otherwise take the money home. And so we want it to be that clear to say, okay, here's where I'm going, here are the metrics, here's what I'm gonna spend the money on, here's how it impacts my distributions and my taxes. And if I don't have confidence that it's gonna grow value, then we're not gonna do that project. And then what you're doing is you're tracking and measuring the normalized EBITDA multiple net proceeds on a consistent basis, because you're measuring the asset price and the value of that asset. And you have a formal strategic plan, not just goals. EOS, I love it. We've got most of our clients that work on an EOS based business, and it's not a strategic plan. Those are goals, those are targets, but we need to understand product market fit, where we're going and why, and then roll those into the financials so we know how much it's going to cost us and how it impacts our distributions, taxes, and the value of the company. And you can forecast all this stuff years in advance if you're doing it the right way.
Mental picture time again, or take a screenshot. This is one of probably the 2 or 3 slides. The value of a company is based on its cash flow, and the cash flow, how sustainable it is, how predictable it is, and how transferable it is. It's just a critical concept to understand. Sustainability, does it last? Are you manufacturing plastic straws in California? Well, you might, that cash flow might not be sustainable. Is it predictable? Everybody always thinks about SaaS and recurring revenue and those kind of things. Not all companies are in that, but how predictable is your cash flow? What's the historical trend, and what do you know? How transferable is that cash flow to somebody else? That's going to greatly impact the value of your company. If every decision of your company runs through you, and if you get hit by a bus and nobody can buy paper clips or buy equipment or make another sale, that's not very transferable cash flow. Those 3 things, sustainable, predictable, and transferable cash flow, will dictate the value of your company.
The intrinsic financial value based on the cash flow, like Pat said. And the pictures that I like to show is we have 2 houses, same square footage, same amount of bedrooms, bathrooms, same lot size, same school district. One goes for over double the value of the other one. Why is that? Well, the one on the right is walk-in ready. The one on the left still comes with a station wagon, but it's half the price or less. And there are buyers for both, But the person that buys the house on the left, their goal is to renovate it, do the work that the previous owner did not, to have the value on the one on the right. The one on the right, walk-in ready, means that someone can grab the keys and it's exactly like they want to live in it. And that is what sustainable, predictable, and transferable cash flow means. Is if you create sustainable, predictable, and transferable cash flow, your company's walk-in ready for any investor. And so we're going to go from a picture to then numbers. It's still a picture, but I'll let Pat explain it.
Yeah, these graphs, and sorry, they aren't labeled. This is trailing 12-month normalized EBITDA, earnings before depreciation, interest, taxes, and amortization. It's a proxy for cash flow. We won't go into that today. The graph on the left is literally the trailing 12-month normalized EBITDA for a client of ours. And when we got the information, put it in a format where it showed it to the owner, that is not sustainable, predictable, and transferable cash flow. And he got it in a heartbeat. On the right, that's an example of cash flow. Again, it's represented by normalized, trailing 12 months normalized EBITDA, sustainable, predictable, and transferable. Getting this information, understanding this, and being able to know where you are today, and then plot a path forward to get to where you want to go is just critical.
And the key behind this is to reduce the company specific risk. We covered a lot of this in the training that Andy talked about at the beginning. What do we do about this? How do we reduce the risk in our cash flow, and how do we create more sustainable, predictable, transferable cash flow? It's by focusing on these 8 functional areas. And these 8 functional areas, I don't care if you're a medical device manufacturer, if you're a software provider, or development shop, or if you're a home remodel, it doesn't matter. Every company has these different functional areas, and they come together to produce sustainable, predictable, transferable cash flow, and they need to be in balance. So if you think about it, like Pat said, my dad and I, owning a copier and IT company, it was a sales machine. So every extra dollar that we had, we invested into sales and marketing. However, when you don't have good financials and you don't have a good ERP system, you don't understand how much inventory you need, it's hard to scale, because you run into cash flow issues, you run into stress and anxiety. And Pat might even drop dead. I'm saying this, that sales doesn't fix all problems. So
this is being recorded. Okay.
Yeah, this is being recorded.
Well, so I'm gonna mark
these need to be in balance, and then they all need to continue going up in conjunction with each other. And this is the lens that people should have if they're running EOS and they're trying to pick what projects and where to spend the money. De-risking it by making sure that these are all in balance, and that you have a level of maturity in each of these areas will help make your cash flow more transferable. Because if Pat wanted to buy my business, well, if Andy wanted to buy my business, because Pat's already a partner, if Andy wanted to buy my business, I could hand him a baton and say, here's a strategic plan, here are the financials, here's who does what, and there's systems behind everything. Here you go, Andy, and I would like all my money up front. That's the options that we want everybody to have. And did you put your screen on because was that an offer? Are you willing to? Just kidding.
Yeah, I was just coming in to make the offer. No, I'm just here for the end. I'm here for the end.
So this is a really short principle, and you need to understand that the team of advisors around you get it, and they have the capacity, and they're willing to help you get where you want to go. I knew what we were going to be saying is you need to surround yourself with advisors that get it. That's why we're so excited about the partnership with Bergen and all the services that they have and the people that they have, because it is very difficult to be around it. It's very difficult to find advisors that truly get it.
So if you're unintentional when it comes to your advisors, you may keep advisors based on emotional or legacy reasons. Your family's had the same lawyer, the same CPA, the same insurance company, whatever, forever, or they're your wife's cousin, does wills and estates, and you're having them draft, purchase agreements or something. That's being unintentional. You haven't asked your advisors, how many business owners do you advise in your specialty area? We have a client now where he's getting ready to make an acquisition. I got on the phone with his lawyer. I'm like, how many deals have you done? I just got real specific and asked him, so that you make sure you have that. Something that's on the business owner is if you're unintentional, you haven't provided them with a holistic plan of where you're trying to get to. So they can help you. If they understand where you want to go and why, then they can help you get there. And so it's just critical to think about your advisors and to be real. If you're unintentional, you're going to have the anxiety that comes from fallen down in all these areas. I almost went to the intentional side.
Well, because it's hard not to, and that people obviously get the trend here is, you have when you're doing this the right way, you have advisors that have the right true technical expertise. They work with business owners because it's complicated. You have a lot of illiquid assets, different entities, a lot of stuff going on. And when you're doing this the right way, you have a holistic plan and everybody's collaborating to get you where you want to go. And your advisors know what you want and why, and can help you make decisions based on what you want and based on the things that are in front of you. I like to show this graphic because this is exactly how I felt when I was running our business and we were bringing in all these different advisors. I'd sit down with our CPA. I'm like, oh, that would sound like an awesome tax strategy. They'd leave. I'm like, what is? I have no idea what that means to us. But like, it sounded cool, and I don't want to pay more taxes. But like, what does that mean? Let's just go sell more stuff. And whatever designation it is, this is what it feels like. And you are by default becoming the general contractor that is synthesizing the order, the cost, and how to do all this stuff. If you're not having people talk together around a holistic plan, this is what it should look and feel like. You don't need all these people on your payroll right now or be engaged with them, but you need to start building trust with the people that get it, want it, and have the capacity to work with business owners, and they understand the long-term value of a relationship and how to collaborate with other advisors that don't have egos. And again, benefit of working with someone like Bergen is that, you can either go find a bunch of different firms that they're going to solve these problems, or you can work with a company that, has a lot of these underneath one umbrella, and they can collaborate together, and they're not going to be fighting over the same penny. And so I think it's just important to build relationships and get these people to understand what you want, so they're not learning what you want in the middle of a huge decision that you have to make, and the stress is very high.
Let's watch the time here. Again, if you don't know where you're going, you're going to end up somewhere else. Yogi Berra is famous for saying that. And you can move. Again, we're going to go back on the next slide, Ryan, to that same picture that I think people have. The intersection of creating wealth, enjoying work, making an impact. That's what we're trying to help people get to, and Bergen's trying to help get people to understand living in that intersection is the best way to go.
And this is the last slide, is the takeaways are, you got to think about what do you want from the business and why. What is the value of your company today, and what does it need to be worth for you to hit your 3 financial targets and create the exit options you want? And are your financials organized in a way that allow you to see your company as a financial asset and give you the ability to run your day-to-day operations like you want to? Sandy, I'll pause there. I won't pull up the training slide yet, but I'll tee it over to you.
Well, I'll close with a little story. And first of all, thank everybody for attending tonight. My oldest son got married this weekend, and I have a Google Maps story that relates to what you talked about earlier. I got a call 20 minutes before the wedding, as we were lining up to walk down the aisle, and it was my mom. She said, "Hey, I'm on Google Maps, and the road's closed to get to the church. How do I get there?" So I'm in line trying to negotiate and figure out how to get them to the church. My point being, I see that with business owners a lot. They get to the finish line and they want the answer right now, and a lot of roads are closed at that point. So it's one of the questions we really didn't talk about was, when should I be doing this? Does this even make sense for me to do at the age of 40, 30? If I could have every business owner go through a process like this the day they bought the business, they would outperform all of their peers, no question, period. So the time is now for everyone. Doesn't matter what stage of the business you're in. And the sessions, if you decide to sign up, go in depth into each one of these principles.
Want me to throw that up?
You're going to see and hear a lot more. So it's interactive. You'll be on the screen for those participating. You might, if you're comfortable, you can bring in specific scenarios and we can talk through those. So we hope to see you as part of the sessions. And as like I mentioned on the front end, if you have any questions, do not hesitate to ask. Whoever invited you to the sessions, you can route them through them, or you can send them directly to me, and my name's on the screen, but it's just andy.hawkins@bergenkdv.com. Otherwise, we'll see you for that first session. And go ahead, Ryan, finish up.
Well, I was gonna say one last, just kind of logistical overview of the program. So it's like I said, it's about 6 hours, and you're going through the material in between the calls. So these calls are Q&A. It's kind of like a little mini peer group for 90 minutes, talking about the topics that are most important. This is based on case studies. You're not sharing your financials. So like, no anxiety, no, you don't have to be, no judgment. Like, I want to hear the dumbest questions that people have, because that means that we're addressing things that people are worried about. Like, what is EBITDA? What is the value of a company? How does this work? Everybody's freaked out about this. The whole point is just to understand the material based on the case studies. So that way, again, when you're done, you walk out clear on what you want and why, how this stuff works, so you can go better utilize your advisors and make a plan. Because like to Andy's point, why would you buy a company or do this if you don't know if it's worth it or not? Like, I mean, God, the amount of anxiety that everybody has, but like saying, okay, well, I'm putting a lot of time, energy, and money into this. Like, what's it worth? What are my options? That's the level of clarity. And again, it should be day one when you create your EIN number, or the next best day is, the moment that you need to make a decision that's better, and picking up the education is something easy to do.
All right, and with that, thank you again for attending. Any questions, make sure you get them to us. I did get one question while the sessions were going on. The recording will go out to everyone. Usually takes about a day for it to process through the system, and then we will send that out to everyone who provided an email. And if there's anything else you need, just don't hesitate to reach out, and we look forward to seeing you if you choose to attend. And Ryan and Pat, thank you again for hosting today.
Thanks,
Sure.
everybody.